Thank you so much. Now I would like to invite Dr. Salman Ahmed Shaikh, Director of Islamic Economic Projects Pakistan, to disseminate his research findings on the topic of factors affecting liquidity risk in Islamic banking in Pakistan. Huge round of applause, please.
All right. Okay. All right. Bismillah ar-Rahman ar-Rahim. So I will be presenting findings of my paper on factors affecting liquidity risk in Islamic banking in Pakistan. So this is going to be my presentation outline. First of all, few statistics related to the progress of Islamic banking in Pakistan. Then I would discuss what is the issue of liquidity risk in Islamic banking and how is it relatively even more unique in Islamic banking as compared to conventional banking. Then I would discuss my research methodology, that how I did empirical work to find out what are the factors affecting liquidity risk in Islamic banking in Pakistan. I would then present my data analysis and finally a few recommendations. So if we look at the size of Islamic banking in Pakistan, it has been growing. Now the asset base has almost touched the 7 trillion mark. The deposits have crossed the 5 trillion mark, and the financing has crossed almost the 3 trillion mark. If we look at the market share has increased to 20% of the overall banking sector. And if we compare it from 2002, when the market share was only 0.5%, it's a very impressive progress, and it has been showing impressive progress ever since 2002, when the first Islamic bank in Pakistan was established with the name of Mizan Bank. If you look at the branch network has also crossed the 4,000 mark, and now there are 6 full-fledged Islamic banks in Pakistan. Faisal Bank has converted itself into a full-fledged Islamic bank, and Summit Bank is also now trying to do the same. So if you look at the asset, deposits and equity side of Islamic banking, we see an exponential growth ever since 2006 to now 2023. We see exponential growth. If you look at finance to deposit ratio, initially it was relatively on the higher side, but then there was a decline in the finance to deposit ratio, particularly because of the problems in the economy, and especially in the real sector of the economy, the industrial and manufacturing sector of the economy, which is the main target market for Islamic banking. But when the products like running musharaka were introduced in you can say 2014-15, then running musharaka increased, and the financing mix increasingly made use of the products like running musharaka. So that is why we see increase in finance to deposit ratio ever since the running musharaka product came to the Islamic banking industry. If we look at the gross financing and investment ratio, what we see is that initially Islamic banks were very passive. They were parking their surplus liquidity mostly in investment instruments, but now with running musharaka, now they are financing more intensively, and even the finance to deposit ratio in Islamic banking is even better than conventional banking now. So initially the gap between financing to investment ratio was very high. The investment to asset ratio was higher than financing to deposit ratio, but now we see that the reverse is happening. If you look at the asset quality of Islamic banking is even better than conventional banking, and it has been the case right throughout history. In conventional banking, the non-performing loan to total financing ratio is as high as 8% to 10%. But in Islamic banking, it has remained on the lower side, less than 5%. Initially, there was an increase when the great financial crisis hit Pakistan economy as well. But afterwards, what we are seeing is that there is a decline in the non-performing financing to total financing ratio. If we look at the efficiency level, operating expense to gross income ratio, initially Islamic banks as new entrants in a capital intensive business were not very efficient, but now as they are getting more business and they are getting scale advantage, so now what we see is that operating expense to gross income ratio is decreasing. If you look at the relationship between the price of capital, inflation and the return on equity, what we see is that the return on equity is now mostly positive. For the overall industry, it is now even more than 20%. And interest rate movement does not affect profitability of Islamic banking as much. as we see in this graph, which has a very mixed kind of a trend. So if we look at liquidity risk in Islamic banking, what happens is that Islamic banks have some unique aspects of liquidity risk. What is liquidity risk? It arises when there is surplus liquidity which does not generate enough income, or when there is shortage of liquidity and Islamic banks need to have funds to manage the customer deposit withdrawals and meeting other liabilities. Now, what are the tools to manage liquidity risk? Simple tools are that you diversify the source of funds. You try to take deposits from multiple angles, not just the remunerative deposit, but also non-remunerative deposits, and not just catering to the retail investors, but also to the high net worth individuals and the institutional investors. And reducing the concentration of funding base, not taking deposits from just one source, but from multiple sources, and then relying on marketable assets in financing operations. Because if, let's say, there is a default and you have to liquidate the asset, if the asset is marketable, then it will not lose much value when the liquidation has to be done. If you look at the nature of liquidity risk in Islamic banking, there are some unique aspects. Like, for instance, the instruments of liquidity management in Islamic banking are much limited as compared to conventional banks. Conventional banks can use T-bills, they can use reverse repo transactions, they can use derivatives, but Islamic banks cannot invest in T-bills, they cannot invest in certificate of deposit, they cannot enter into repo, reverse repo kind of transactions. They also do not have lender of the last resort facility from the State Bank of Pakistan. And also, when there is, let's say, asset quality risk in Islamic financing portfolio, they cannot reprice very flexibly. For instance, in Murabaha, when the price is agreed upon, then it cannot be changed. So if any late payment penalty is also charged, Islamic banks cannot take that in their income. So all of these are unique aspects of liquidity risk in Islamic banking. What are the issues in liquidity management? There is very inactive interbank market in Islamic money market. We have very lack of Sharia compliant instruments, especially sukuk. Government is financing its public finance 98% through conventional instruments and only 2 to 3% from the sukuk. And the sukuk are also not available for shorter maturities. They are available for 3 years, 5 years, but when it comes to T-bills, T-bills have maturities of 3 months, 6 months, 9 months, 1 year, but there is no alternative of short-term liquid sovereign instrument in Islamic finance. So all of these create liquidity management issues, and also because Islamic banks cannot enter with conventional bank flexibly. So for instance, if conventional bank is doing interest-based business, Islamic banks cannot park their liquidity in conventional banks. Yes, when they need funds, they can take deposits from the conventional banks because Islamic banks would be ensuring Sharia compliance, but same cannot be expected from conventional banks. So this creates a dichotomy as well. Now coming to the empirical part of my research, I looked at how the different factors are influencing liquidity risk. Liquidity risk is measured through finance to deposit ratio. So when finance is provided, it is creating an outflow from the bank, and when deposits are coming, it is creating an inflow to the bank. So the finance to deposit ratio would look at the balance between the inflows and outflows. I take cost of capital, and the proxy is interest rate as an independent variable, log of asset, which is a proxy for size, non-performing financing to total financing ratio, which is a proxy for asset quality, and return on equity, which is a proxy for profitability. If we look at the results, so these are the results from the long-term equation. VECM model was employed. So summarizing the results, what we can see is that two variables have a negative association and two variables have a positive association with liquidity risk. So all variables are statistically significant in the long run equation. I have not shown the adjustment parameter, but that was also statistically significant and the sign was negative. Size and credit risk have a positive association with liquidity risk. It is possible since big size banks are in a position to afford a funding strategy by funding their financing operations from other sources than deposits. On the other hand, credit risk in long run goes hand in hand with liquidity risk. So if there is a problem in the asset quality, it will also boil down to creating enough liquidity risk as well. So if the asset is not performing well, then definitely there will be a liquidity risk down the road. Lower asset quality might lower the cushion of deposits and hence leading to higher liquidity risk for banks in the long run. The results also reveal a negative association between profitability and funding strategy. The plausible reason for that is that profitable banks would have lower liquidity risk because they have greater avenues to manage their liquidity as compared to the non-profitable banks. The cost of fund also have a negative association with funding strategy, and the reason for that is because the deposits are much less elastic to interest rate as compared to financing operations. So when interest rates change, the financing portfolio would have more elasticity, but the deposits do not have immediate increase in interest rate. So what happens is that bank is in a better position when interest rates are high, because when interest rates are high, the financing portfolio would yield higher return on the higher interest rate. But when the deposits, if you look at the deposits would not have enough and immediate increase in profit rate when the interest rates are high. And then I also looked at the impulse response function. So you can see that if there is a 1 standard deviation shock in size, it creates a negative relation with liquidity risk. Likewise, asset quality has a positive association with liquidity risk, and if there is a 1 standard deviation shock in cost of capital, it also has a negative association with liquidity risk. And finally, if we look at the profitability, if there is a high deviation in profitability, it leads to lower liquidity risk. So these results also confirm the results that we obtained from the long run equation. So my last slide is about the recommendations. What Islamic banks have to do: they have to rely on diverse source of funds. They have to diversify the concentration of their funding strategy, not relying on just one type of deposits, taking deposits from institutional investors and also from high net worth individuals. They also need to revise their deposit rates as well and try to be more competitive. If they are, let's say, paying 1 or 2% lower than the conventional bank, then definitely there will be a commercial displacement risk. And finally, they also need to rely on those type of financing operations where the liquidity risk is lower, need to include those marketable assets which have high secondary market value. And finally, they have to also look at the use of sukuk for their funding strategy. So when, let's say, syndicate financing is needed and they have to provide financing to a large organization or to a large project, so what they can do is they can provide it through a consortium of banks rather than trying to park all of their liquidity in just one contract. So if they do syndicate financing through sukuk, through third party placement, then definitely they can diversify their liquidity risk. So I will end my presentation here. Thank you for listening.